All right, we'll go ahead and get started. Welcome everyone to the May, Dorsey, and Whitney Bank Counsel Roundtable. My name is Jay Kim. I'm a partner here at Dorsey and Whitney, and would like to welcome all of you who are participating in person here in Minneapolis, as well as those who are participating by webinar. For those of you here in Minneapolis, please remember there are CLE sign-up sheets in the room, so please remember to sign up on those. As always, there'll be a reception following the program. And then for everyone, this is a 1-hour program, and we will always do our best to keep to that schedule. And at some point in the program, for those of you who are listening in from New York and need New York CLE credit, we will announce the New York CLE code. So be ready for that when we get to that point. Today's topic is will promises be made? Will promises made be promises kept? Adopting AI and other innovative technologies to reduce AML risk. And we're going to approach today's subject really in two parts. Part one is going to focus on the use of AI and innovative technologies to enhance BSA and AML programs. And presenting for part one will be myself and then also Walt Mix. Walt is participating today on the panel by telephone from California. Walt heads the Financial Services Practice Group at Berkeley Research Group. He is a former commissioner of the California Department of Financial Institutions. He's been an executive at Union Bank of California and has over 30 years of experience in the financial services industry. Of his experiences of particular importance for today's program is having significant experience with Bank Secrecy Act, anti-money laundering and OFAC issues, as well as re-engineering and implementing technology to improve profitability. So welcome, Walt.
Thanks very much. Delighted to join.
And the system works. So that will be part one of the program. We're going to lay some foundation for this subject, and then we're actually going to do a little bit of a panel discussion, Q&A type approach between Walt and I, and then Joe if he chooses to jump in. And then part two of the program, we're going to do an update on recent FinCEN and OFAC developments, and presenting on part two is Joe Lynyak, also a partner at Dorsey and Whitney. So where's my clicker? So to start with, and I'm going to call it this for a reason, the inspiration for the program today is a joint statement on innovative efforts to combat money laundering and terrorist financing that came out in December of 2018. And one of the reasons that at least caught my interest is that we're starting to hear a lot more about AI and innovation in both the business operations of financial institutions and other companies, but as well as in the reg tech space as you look at how you're going to deal with increasing compliance burdens. And this is an area where deployment of those types of concepts and ideas will, I think, come under more significant scrutiny because it is one of the enforcement areas that receives a particularly high level of attention. And lastly, what is unique about it in my mind is that while you as financial institutions and advisors to financial institutions may be starting to think about how you innovate in dealing with your compliance obligations here. At the same time, the perpetrators of financial crimes are at the same time innovating at almost a similar pace. So you've got a problem that's evolving constantly, and you have solutions that are evolving constantly. And it seemed to be that when you have a statement like this come out, you need to start looking at it and say, well, what does this really mean to us in terms of dealing with an area of this type? Because when you have changing problems, changing solutions, and then you have regulators in between trying to judge the gap and how well you're meeting it, I think it presents a particularly interesting scenario and problem for all of us to deal with. So the premise in the joint statement is that the agencies recognize that private sector innovation, including new ways of using existing tools or adopting new technologies, can help banks identify and report money laundering, terrorist financing, and other illicit financial activity by enhancing effectiveness and efficiency of your BSA AML programs. So, I tried to go through this and say, okay, well, what are they really telling us and what are they really promising us in this statement? I think there's maybe potentially one promise in here of the whole thing, and that is that they will not penalize or criticize banks that maintain effective BSA AML compliance programs if you choose not to pursue innovative approaches. So I suppose that's a little reassuring. But then beyond that, the statement also focuses on the importance of pilot programs and the importance as an important means of testing and validating the effectiveness of innovative approaches. This is another place where it comes, I think, close to being a promise, but not quite one. And because there are a couple sub statements in the policy statement in this area. One is that while the agencies might provide feedback, pilot programs in and of themselves should not subject banks to supervisory criticism, even if the pilot programs ultimately prove unsuccessful. And I'm going to come back to that concept in the next one as well. And the next one is that pilot programs that expose gaps in your existing BSA AML compliance program will not necessarily result in supervisory action with respect to that program. So while on the one hand, encouraging pilot programs to test innovative concepts is encouraged, it won't necessarily result in enforcement action if it reveals some gaps. So there is some risk in participating in that component of the policy statement as well. And then lastly, there is a note, and I'm not going to spend much time on this, and that is to the extent necessary and appropriate, FinCEN will consider requests for exceptive relief to facilitate testing and potential use of new technologies. So I think the context for those promises, one of the things that's important to see in the statement is what are the conditions, that all through this you must continue to meet your BSA AML compliance obligations, as well as ensure the ongoing safety and soundness of the bank. So if you go back and look at those promises, you won't be penalized for piloting a program or innovation that fails. Well, that's in the context of a program that is continuing to operate the way it's supposed to. So there is, I think, in this policy statement for the regulators somewhat of a safety net. They're not giving you the ability to shut down a program while you pilot something. There is a foundational program that continues to need to operate while you're testing new ideas and new concepts. Then the next condition that I want to highlight is that the evaluation condition. And I think this is one that is going to be one of the more challenging ones for all of us and may already be proving to be challenging in the BSA AML space. And so bank management should prudently evaluate whether and at what point innovative approaches may be considered sufficiently developed to replace or augment existing BSA and AML processes. And when I see this one, I think a little bit about change management as part of your internal control processes and in general, and how change management might be evolving in your organizations as well. We recently had a situation at a financial institution where there was some disagreement and some issues over the adequacy of some internal controls, and part of it came from a misunderstanding between the IT area that had moved to an agile, iterative approach to dealing with change and change management to another part of the organization that was still looking for a process that reflected an older waterfall style. And it became apparent early on that they weren't communicating well. I think what we will see, and when we start talking and getting Walt's input, probably we'll see more in this particular space when you have these types of innovative technologies, which are probably more suited to an iterative step-by-step approach, is that we're going to see more of this maybe miscommunication with regulators perhaps who are used to seeing a more complete solution adopted in a waterfall environment as opposed to one that might be implemented on a more iterative and agile basis. Further on the evaluation front, in addition to evaluating the effectiveness of your AML BSA program, is the expectation that bank management will also evaluate other factors, including information security risks, third-party risk management, so vendor management aspects as well, compliance with other applicable laws and regulations, customer notifications and privacy, and then model validation. And I think this, in addition to kind of process management and change management process, is going to be one of the other areas for this particular statement that may prove challenging. you think about a model validation in the context of regulatory policy statements on expected model validation in general, there is a question of what is the model you're actually validating. And we get into this type of space where you have AI and machine learning, where arguably the algorithm is shifting on you and isn't static at any particular point in time. When you're going back to validate that particular model, it's in changing circumstances, both in terms of the model or algorithm that's being used, as well as probably the data pool that you're relying on as well. And I think that can be particularly challenging. And I'm not even going to suggest I know how to solve for that one, or that someone does, other than recognizing that it is a lot more dynamic than maybe some of the more traditional model validation your organizations have been through in the past. And then the other thing in the evaluation space that's important to note is bank management should also discuss their evaluations with their regulators. And I think the importance here again is that if you have regulators who are talking about or looking at a situation from a different lens in terms of iterative versus waterfall, or how new technologies are being implemented. If you wait until they come on site to examine what you're doing, my experience at least has been is regulators tend to be reactive, and if you can reach out to them beforehand as you're moving through this, you can be more proactive with them, and they can have a better understanding of what they might see when they get in the door, and develop their knowledge appropriately. So the notion of discussing evaluations with your regulators as you're going through this process, I think, has value there, but it does go back to those two conditions on pilot programs. If your pilot program reveals gaps in your BSA AML, they won't necessarily pursue enforcement, and through this communication is where that issue could arise. So I think caution is warranted there as well. The policy statement also talks about agency innovation. This is, I think, not a lot different from the sandbox concept that Tom Scanlon talked about in our program a couple months ago. So probably not a need to spend additional time, other than it is going to be particularly focused on these areas and some of the challenges that I've already mentioned. So I want to just do a little segment on just kind of vendor innovation and promises made, because I think this is a space where how you respond and how you innovate is going to be, for many organizations, dependent upon the vendors you use and what they're promising to you. And this becomes a little bit of a function of vendor contracting and how that vendor is going to partner with you over time. So in this example, as we're going through, talked a little bit before about the policy statement. Now we're talking about what's the promise the vendor's going to make. And at the end of the day, you want the vendor to promise to meet this premise that the policy statement started with in the first place, that private sector innovation can enhance effectiveness and efficiency in BSA and AML. So what promises do you want them to make? And will those, I think the first thing you want a vendor to promise you in this space is that the conditions in the statement will be met, so that your ongoing BSA AML compliance obligations will be met when developing pilot programs and other innovative approaches. And then I've just added, without excessive operational costs and redundancies, at any moment in time. I'm talking about measurement there, and then also from a medium and long-term perspective. And without material operational lag or reductions in capacity, and without incurring short-term operational costs that overwhelm the long-term benefits. I think one of the things we see in this space is that it takes a lot of time to implement this type of technology, and it takes a lot of time to get it in a place where it's overall effective. You might have components that work sooner rather than later. And if you kind of go back to, I suspect, the conversations you have with management when you're talking about doing something like this, there is a cost factor here, that if we do this, we can reduce maybe some of our overall costs, because the technology will overtake some of the things that we use personnel for before, or at least contain cost growth in this area going forward. But on a implementation scale that's going to run maybe in upwards of a year, that's a long time horizon to start showing the benefits for this type of project. And I think it does take a little bit of a mindset, but you need a partner that can help you get there as well, in terms of setting those expectations at the front end in terms of when these results are going to come, and managing them on an ongoing basis. So really looking at that cost factor as well. I think the other thing that vendors are really important partners on is successful evaluations. So, if the premises are promises, would they be kept? And in this type of environment, again, I think a measurable scope, objectives, and success criteria, robust data analysis that allows you to measure the performance of those pilots in particular components, as well as the overall program as it progresses, ongoing testing and validation, and the ability to be agile. And here, I think one of the things that I think is important to keep in mind is that, especially for regional and smaller institutions, is that I think it's often the case that technology vendors will come in and say, we have this wonderful off-the-shelf product that's going to solve this problem for you. And they probably try to sell that notion a little higher up the size scale as well. And this just doesn't seem to be an area that's conducive to that. And so I think when you go in and look at evaluating performance criteria and scope of work in a vendor contract in this space, it has to recognize the flexibility and agility that needs to happen for this to be successful and evolve as your program evolves, as the challenge that you're trying to fight evolves, and as I think regulatory knowledge evolves as well. So in addition to those factors, something that's agile and effectively implemented in a flexible manner, you want them to provide the support you need to meet those other management evaluation criteria as well. So information security issues, third-party risk management, vendor management, compliance with applicable laws. Model validation as the vendor, not necessarily, of course, that they would do it, but they would provide a structure within which model validation can be more easily implemented with a third party, or maybe at some point with your own internal staff being able to navigate that model validation, again, given the evolving algorithms and models and data pools that can be involved here. And then also unintended consequences and governance expectations, getting a program that effectively does match out with what your internal control expectations are, and if you're running a GRC system, that it integrates into that as well, and is part of that overall governance, regulation, and compliance system that you're trying to implement. And then finally, I think, and this is key, and this is, we'll get to Walt and after this slide, is having a vendor that can assist you with regulatory communications and engagement. Again, throughout that process, help you be proactive with the regulator from one iteration to the next, and not just in response to incidents and emerging threats, but also for ongoing model validation. So that's kind of a high level of what you take as I think is a relatively brief policy statement on innovation and some of the things that drop out of that as considerations. And I wanted to put that out there as kind of a baseline, and then have Walt jump in here and give you a strategic advisor's perspective. And then after that, we're going to kind of do a little Q&A and try to pull this all together for you. And so with that, I'm going to turn it over to Walt.
Terrific. Thank you, Jay, and thank you, Joe. Thanks also for saving me making another trip to the East Coast. I'm headquartered here in LA. Silicon Valley's up north. We have our own tech area known as Silicon Beach, which is out by Santa Monica. And so technology and fintech and AI are like a shadow that follow me around out here. And I've been working with machine learning, blockchain, and AI for about the last 5 years. So I hope I can share some real-world insights with you. I do travel around the country and overseas, and I like to joke that I see what's really happening below the waterline, so to speak, all those things that are ingredients into a successful plan. So looking at the first slide in terms of market trends, if we could put that slide up, really my view of what's happening here is the entire financial services industry and technology industry are coming together. Every year I speak at a big conclave of the tech industry and financial industry called Sibos, and it's about 10,000 people who get together globally And some of the takeaways from that meeting include one of the biggest regional accounting firms in the United States has indicated that it will be moving to robotics and machine learning over the next 3 years. Some of the big four firms have already installed artificial intelligence in some of the biggest banks, and the biggest banks are able to develop most of what I'm going to talk about in-house. So there's significant market activity, and what this is leading to is a change in the fundamental business model of many banks. I was recently at a meeting in La Jolla, TISC, and for you golfers out there, the 2021 U.S. Open is going to be held there, so you can put that on your calendar. But large global banks that constitute the payment system globally are in the throes of re-engineering their processes really over the next 3 to 5 years. The lead article in the most recent edition of The Economist magazine shows a piggy bank, and the piggy bank is being eroded by the fintech industry, and it's called tech's raid on the banks. I don't quite view it that way, but suffice it to say that on the consumer side, there's a significant shift as well. So the market's really changing. The regulators are seeing this. They've all announced strong support for innovation by banks. Jay has done an excellent job of describing for you what that view from the regulators is and some of the practical issues that come into play. And so I'm going to try to give you, again, what I've been seeing below the waterline that may be helpful to you to think about as you consider this in your practices or at your financial institutions. Really looking at the goals, we try to come in working with a law firm, working with a bank, working with the right sources of information to help create what we view as a competitive advantage, and that is all tailored to your specific business model, your specific business plan or strategic plan, and we help financial institutions to analyze the cost benefit of creating machine learning or creating artificial intelligence. And we'll, as Jay mentioned, we'll give some examples in that regard later on. One of the specific things that we look at is an institution's concentrations. We look at what they're best at, and then we try to help them leverage that further by getting to know their customer more in depth. So think about this as not just risk management. Think about this as getting to know your customers better on the marketing and on the business planning side so that you can focus on those customers and more like them in your space. We've been working with a bank here on the West Coast on exactly this. They've been able to identify and target the best customers in their markets and reach out to them, come up with the most competitive pricing, the best relationship management, and of course the best risk management, which again goes to creating competitive advantage. One of the things we found in terms of an institution's risk profile is many times an institution will consider themselves to be of medium risk profile when in fact that institution is a high risk profile institution given its products and services and its geographic reach. So this process, again, helps you to get to know your customers better and to control that risk. In terms of risk mitigation, the way we think about risk mitigation is we take a holistic approach. We view risks as being interrelated. Think about the Mossack Fonseca scenario, otherwise known as the Panama Papers, where there were cybersecurity issues, BSA AML issues, and those really did come together to create tremendous risk, not only for that law firm, but for all of its clients. We've been working with a number of institutions on both coasts on sanctions-related projects, and machine learning and artificial intelligence can be extremely helpful there as well, not just on the front end KYC, but in terms of ongoing monitoring. And I would also add, don't forget the privacy requirements, and this might be something that Joseph will talk about later. Not only do we have GDPR, but we also have here in California our very own new privacy requirements that apply to institutions operating here. And there's a question as to how to create a platform from which to operate that addresses all these differing privacy requirements. Moving to the next slide. If we could have the next slide, there we go. We always start out with the question of whether your current program is at a best practices level. And our view of these types of analyses, our approach, if you will, is to compare an institution's program to industry best practices. We look at all 5 pillars, and I'm sure that everyone knows what those are, but we put our analysis into the context of what we call people, processes, and technology. So you can view 3 circles that essentially overlap in the middle. Again, people, processes, and technology. We also look at the 5 pillars, and I'll digress for a second. I was recently on a panel with the federal regulators for not only the banking-related institutions, but also FinCEN. And what these regulators are really looking for, and this was encapsulated in what Jay covered with regard to the innovation statement, they're really looking for an effective program. They want an overall effective program, and with the statement simultaneously, they're also looking for more innovation and more cost-benefit analysis based on the potential implementation of AI, machine learning, and other types of approaches. That's what we're seeing in the marketplace. That's what we're seeing from the regulators from New York to Chicago to Miami to San Francisco and Los Angeles. So those are clearly examples of what we're seeing below the waterline. Moving to the next slide in terms of do's and don'ts. We think that it's important to take a thorough look at an institution's strategic technology plan, also take a look at its strategic plan itself, and determine, much as some financial institutions have been doing. I think everyone's familiar with the BB&T and SunTrust merger. There's a perfect example. The stated rationale was that they looked separately at their technology plans and what it would take to meet those, and decided it would be more advantageous to come together because of the costs and because of all the work that's involved. We look at, and this is very important, we rationalized the data on the front end. We worked on a M&A project last year where we had 2 other institutions that were running simultaneous systems, and when they did so, they found that they had 6 or 8 old, siloized, antiquated systems that caused mispricing, which led to accusations of customer harm and led to restitution, and I think everybody knows the scenario. So there's some serious underlying issues here for many institutions, and in our approach to some of these types of issues, and when we're setting up a new system or helping an institution to analyze machine learning and AI, one of the first things we do, of course, is we set up a parallel process where we set up a data pool, some call it a data lake, where we introduce part of the bank's data into this new system and spend a lot of time rationalizing that data, and we work with the new technology system, sometimes true AI, some machine learning, to analyze portions or a sampling of a bank's information. Very briefly on system validation, this is something that I think needs to be part of the plan from the get-go. Many times you don't see true system validation until perhaps a year after having gone through the process of implementing machine learning or artificial intelligence. We also have, being out here on the West Coast with Silicon Valley and Silicon Beach, we have a constellation of outsourced providers that we work with, covering all areas of artificial intelligence and machine learning. One of them analyzes artificial intelligence in terms of the accuracy of the algorithms themselves. They also analyze, and I think this is an important point for many companies, they also analyze any inherent biases that may arise as part of the use and implementation of algorithms. In terms of core competencies required, this leads to the next page, where we talk about the approach that we have created. And I'd love to say that I invented it all on my own, but of course I did not. This is something that is gleaned from many, many years, frankly the last 20 years, of experience working with a number of different players. So you can view this much like a stack of services. And on the top layer of the stack, we see a law firm that can do the sorts of things that Joe and Jay can provide, all the issues that you heard from Jay and you're going to hear from Joseph. One of the key issues is going to be looking at beneficial ownership issues. I think everybody's familiar with the beneficial ownership guidance, but how much is enough? And when you're thinking about, for example, in Venezuela, what would constitute a Maduro-related transaction, right? So we work closely with law firms on those types of issues. The next layer would be expert consultants who meet the requirements set forth in the vendor risk management guidance. The next layer would be the new system itself. And then I term this enhanced information. Many institutions use publicly available information like WorldCheck. We have found that in some of the trickier situations, like Venezuela and other sanctions projects, that information just doesn't go deeply enough. And so we work with other providers who can verify information, if necessary, go on site to review and verify information. Because after all, I think everybody knows if it's junk in, it's going to be junk out. So that is the type of approach that we've been putting into place. One last comment before we move to the next slide is the regulators have been emphasizing to us that they really want banks to be able to view transactions and sanction issues at what we call the customer level. So think about the absolute antithesis of silos. Think about enterprise risk management or proper corporate governance writ large across the institution, so that the system and the staff and management and the board can view all transactions of an individual customer, whether they're deposits, wires, loans, et cetera. So that does it for that slide. Moving to issues and ideas. Jay, did you want to kick off this one?
Sure. Well, and I think a good place to start might be, I think when we last talked, there were a couple of recent examples that you had in dealing with clients in applying some of your approach to the BSA AML space. And I think that might provide a good platform for getting into some other the issues we have to talk about.
Absolutely. So think about a particular region. It could be New York. It could be one of the cities on the West Coast. It could be a city such as Miami, where a group of banks can come together and implement that layered approach, that stack approach that I just outlined. After all, many of these services are not inexpensive, even though they can produce terrific results. Our experience is that we can create a platform that can be shared by a number of financial institutions, and that's obviously where a law firm can be significant in its involvement as information is shared using 314A and 314B. Another example is a very large regional bank, and pardon me for not sharing which coast it's on, but whether it's east or west coast or southeast, you can think about the international exposure that an institution might have, and again, using that approach of enhanced information, advanced technology, the right consulting firm or expertise, and a law firm can be extremely valuable in terms of creating more information about your customer base, more information about individual customers, both from a marketing and risk management perspective.
So then, Walt, when working on those engagements, I think one of the things that's come up is just, how do you approach model validation in this space when you have AI or machine learning involved in probably shifting the model? And as I mentioned earlier, what you're defending against is shifting as well. Have you seen any particular approaches that work well with that? And I think both maybe at a high level when you're dealing with more sophisticated people in the regulatory structure, but also out in the field?
Right. So one of the things we found is that there's a process of mutual adaptation that occurs between the financial institution and its regulators. And we like to start that off very early in the process by speaking with the regulatory agencies at both the policy level and the examiner level to ensure that they clearly understand what the institution is trying to achieve. This requires very in-depth and frequent documentation because after all, one of the keys is going to be looking back once the artificial intelligence or machine learning capability has been implemented. One will want to be able to look back and see exactly what details surrounds individual customers and how that is aggregated and presented at the institution. So we've done things like running high-risk customer reviews and comparing it to not only best practices and external validated algorithms, but we've also compared those to the information that the institution had internally to see what discrepancies might exist or might arise, and come up with explanations as to why the different runs are separate. Mm-hmm. So those are the types of things that we've been doing. I think one of the hallmarks of our regulatory system is many regulators extol the virtues of examiner judgment in the field, and in many cases that works quite well, but in the scenarios that we're talking about here, working with examiners early so that they understand and so that trust is gained, we find can be extremely important in terms of dealing with field judgment issues and examiners.
So then, when you're working with regulators in that context and setting out what your goals and objectives are, maybe for the overall program you're trying to implement, we're starting to hear more and more about, kind of this agile architecture. And so, a situation where at, the initial stage, you might get to a point, do some data analysis and testing, and then change things a little bit going forward. Do you have any thoughts on how best to communicate that type of process to regulators so that they can understand that a change in program and expectations along the way isn't necessarily a bad thing?
So that's a great question. So I don't know how many people remember what the 1968 Jaguar XKE V12 looked like. So it took.
Wait, I want a show of hands. How many remember what that car looks like? No, go ahead, Walt.
The very long hood, and it took a team of mechanics to keep that car running properly, and regular attention to make sure everything was tuned and running properly. So what we counsel people to do is to set up a parallel system, keep everything running as it was, set up a parallel system. This can take up to 6 months to do. Gradually introduce segments of the institution into the new system, into the data pool, and gradually gravitate that which is learned from the parallel system back over to the existing system. So this is a very incremental model, but we found it to work very well over the years. So where a company like ours is in the consulting role, providing that type of service, we always want to have an external group that's checking our work, much like a teacher checking your math problem when you were in high school. So we'll come up with what we believe to be enhancements. We'll introduce those into the system, and then the independent party will review our work, review the work of the bank to make sure that it's truly achieving, what we think it was supposed to achieve. And we keep track of that all along the way. So at the end of the process, we have very deep documentation independently created and presented to the validation team, which will then look at the overall system.
Yeah, and one other thing that reminded me of, Walt, that we talked about before, and then I want to give the mic over to Joe here, is that we talked about the process you go through with those parallel systems and bringing them together. And the thing that it reminded me a little bit of is that when you do M&A work and you're going into that post-close conversion and integration phase, And, most of those transactions are modeled so that you might get 60% of the savings, so 60% of that work done in the first year, and the remaining, call it 30 to 40% comes in the remaining year. It is an example of something that both, I think, management outside the regulatory and compliance space in a financial institution, as well as regulators, are used to seeing. You can do all the planning in the world in preparation for an acquisition and do product mapping and things of that sort, but until you actually get in and start figuring out how the pieces fit together, you don't know how it's going to work, and you're going to adjust along the way. And that seems to be one of the things that needs to occur in this space as well.
Yeah, just a quick comment. We have found that you're creating a competitive advantage for your institution by implementing AI machine learning, because you're able to set forth to the potential acquirer or target more detail about the value of things like your deposits, the stickiness of the deposits, just as one issue. If you're doing due diligence on an institution, it gives you the ability to look deeply on the front end of a due diligence. And then during the process of merging the two institutions together, just as Jay was mentioning, obviously you're going to have a much more orderly and efficient process as well.
Yeah. And one funny thought that occurred to me when you were saying that is that if folks in this room can go back to their respective institutions and convince management that the new BSA AML system is actually a new CRM, customer profitability system, that'd be fun to see. We're hoping to save some time for questions at the end. I don't want to take too much more of Joe's time. So with that, I'm going to turn it over to Joe.
Oh, well, thank you very much, Jay. Just a couple of thoughts in terms of this discussion, which I think is really excellent. Walt is describing a process that can happen one of two ways. One is your institution decides we really need to do this, and I think he really gave a very thorough discussion of the components of it. But the other side of it, which is happening more and more, and part of it is really being driven by the AML side of it, is the government is coming in and saying, you really didn't do risk management. And the response is, yes, we did risk management. And the government then says, okay, now let's quadruple what we really mean by it. And let's start to drill down and do all those things that you thought you did. And we're going to start all over again. And we are talking about millions and millions of dollars of expense and time and effort in order to accomplish it. And so I guess the observation is, pay me now or pay me later in terms of your institution having to do it. And this is coming, from your friendly neighborhood regulator. Just a couple of things in terms of the overall approach here. I would say that, and I've repeated this before, we talk about fintech companies, fintech this, fintech that. Banks are the original fintech companies. They've been that way over, about 1,000 years. It's movement of funds, it's payment systems, it's doing it more efficiently. And what we're really talking about today is another evolution of it, allowing the integration of new companies, new technologies, in order to be able to make your employees do a job more effectively. And I think that's one of the enunciated goals of AI, of being able to free up your employees to do things that benefit your customers, as opposed to wait a minute, I have to go look that thing up because the information is now in front of them. Two other points I think Walt touched on. One is the buy-in by the regulators, because whatever it is you're doing, they're going to want to measure it, and they're going to want to give some type of good housekeeping stamp of approval on what you're doing in whatever area that you were working on. And so they need to understand what your goals are so that they can say, okay, if you accomplish it, we're going to be satisfied with it. Some people, in case of new technologies, have said to the regulators, here it is, take it, use it, kick the tires and see how it works. But for example, a good issue here, talking about AML and AI, is using it to reduce the number of false red flags, and at the same time then being able to reduce the amount of full-time employees. and being able to get the regulators to understand that that's one of the goals that can work very effectively. We deal with banks all the time where you look back and you see, hundreds of people doing red flag work, and you're saying, oh my God, is this really effective? Well, that's something I think that can be accomplished, and it's got to be accomplished by making sure the regulators understand what your goals are, and they may have to also validate your systems. We don't have too much time here on FinCEN and OFAC developments, and some of the things you can certainly take a look at your leisure, but a few things have come up which you need to be thinking about or be aware of. Actually, the fintech companies have been just going berserk over the years, saying we can do this and we can do that and we can do this, and let's make up names and nomenclature, et cetera. And finally, the empire has struck back, and within the last couple of weeks, both OFAC and FinCEN have issued some guidance which really reasserts what they think is their authority here. And the first is FinCEN's regulations regarding convertible virtual currencies. And it's a very useful document. It's about 30 pages long. And what it does is it summarizes where they're at in terms of the use of virtual currencies and some of the things that you may be encountering. And one of the points here is that they view that CVCs are opportunities for money laundering. And one commentator says that in terms of any trade regarding a virtual currency, you're 2 degrees away from criminal activity. So you really do have a segment of the federal government that is very, very concerned about this. It's not going to go away, and you've got to be really concerned about it. What they also said was, look, our nomenclature counts, yours does not. You listen to the fintech companies, and they come up with all these new ideas. They came up with tokens, dollar-denominated tokens, taco tokens, if you're going to go ahead and buy some food. And fintech said, no. What we're going to look at here, forget about the nomenclature, go back to our regulations and our interpretive guidance and look at what is actually taking place. And then you can decide whether or not you are involved, and you've got to register as a money services business, and whether or not, if you do that, you're probably also going to have to be a money transmitter in most states. And what they also did along the way is they narrowed down some exemptions that frankly should be available on the face of their regulations, but they have wanted to try to capture everybody as much as possible into the web of being compliant with AML and having responsibilities. And so when you read this guidance, they may be saying, oh, hey, don't worry, it's okay, you're not covered. Well, the answer is you may be covered because you're a bank. You may be covered because you've got an exemption, but that throws you into another section of coverage. So you really need to take a look at it, but it's a really, really worthwhile exercise. And it also explains their views about how these different technologies can be used in a manner that is contrary to, to effective AML compliance. Turning quickly to the FinCEN advisory on an activity involving CVCs. This is something that I think is directed at U.S. banks because there's a lot of shenanigans taking place in terms of CVCs. And this document here, I think, is directed at you in that what it says is, look, it explains in relationship to the earlier guidance that I just mentioned, how these things are being used to get around issues and engaging in money laundering. And something to be aware of, they have identified 30 red flags. And ultimately, I think they're going to say, by the way, are you guys monitoring for these 30 red flags? And if you are, then what you have to do is that you've got to give us, FinCEN, information about what it is you identified in terms of these currency transfer activities, including in the SAR, a reference to this guidance, which is FinCEN 2019 A003. So again, it's something to look at in terms of what ultimately I suspect you're going to be asked about in terms of your AML team. And then finally, OFAC came out with a framework for OFAC compliance commitments. And this is probably more important for foreign banks because they have no idea what they're doing, or they're doing things deliberately in an illegal manner, not in the United States, but actually offshore because they sometimes they feel, well, the rules don't apply to us. And this is a very, very useful way of being able to insulate yourself from liability. And what it does, it effectively adopts the U.S. Sentencing Commission's guidelines for corporate compliance and ethics. This thing has now become pervasive around the United States in terms of law enforcement, both at the federal side and on the state side. And this is effectively a reiteration of it. And if you've never read them, you really should, because what it does, it actually provides your board of directors with a very, very sound foundation to say, if we are meeting the guidelines, whether these ones which are slightly reworked or the Sentencing Commission's guidelines, we're doing a good job. And what you can then do is say, instead of enforcement against us, go beat somebody else up, because we've done everything from top to bottom to be able to deal with issues that are concerned to the, again, state governments or federal governments. A management commitment, making sure people are not turning their head and said, oh yeah, let them go do what they want to do. A risk assessment, which is in Walt's province. Internal controls, which are, validate your risk analysis. Testing and auditing. But most importantly, a culture of compliance, which starts at the top and moves down throughout the institution. And that's something that frankly is oftentimes lacking in the case of foreign bank management, not in the United States, but outside the United States. And being able to build that is important. But looking at the guidance that's issued by the U.S. Sentencing Commission, whenever your board is thinking about the question, are we doing things properly? And if you adopt those, if you take those sections and you do an internal analysis or an external analysis, whatever you find is effective, and you get a pass, you're doing very, very well. And then what that does is it leads you to the argument, regardless of the regulatory authority, go bother someone else because we're doing an adequate job in terms of the criterion that you've laid down in terms of corporate compliance and ethics. That is a really quick summary, but again, it's the other side of the process that Jay and Walt described.
All right, then we'll wrap up. Thanks, Walt.
My pleasure. Thank you.